we're actually lucky because I think this correction is giving people another chance. Like this correction that we're having, I mean, this could potentially be your last chance before we see at least quality stocks really move up significantly and quickly, to the point where it's like you're a month or two too late. Then it's like, damn, this stock is 30 or 40% higher. It's so hard, it's so hard to buy it.
To In It to Win It. This is Steve Barton, and thank you for tuning in. We are back with our resident gold expert, Jordan Roy-Byrne from the Daily Gold. Jordan, thanks for coming back on the show.
Thanks so much for having me, Steve. And yeah, you got to be in precious metals to win it, especially when they're in a bull market and going up. So that popped in my head as we start.
Yes, I've got my appropriate Jordan background on here. I figured I'd stack up all my gold bars in the background to to commemorate. Okay, let's start off like we always do. And what is your current assessment of the economy?
Well, I mean, I always like to say I'm not an economist, so I don't have expertise in this area. And, even for economists, predicting the economy is very, very difficult. But, we saw the yield curve invert, basically measures of short-term interest rates went higher than measures of long-term interest rates. I mean, the 2-year yield and the 10-year yield, that's the most common yield curve that most people track. So that became inverted. And that basically usually signals, I think every time it's happened since 1960, there's been a recession, or I think that's right. I saw a statistic, since 1900, it's inverted 28 times. There's been 22 recessions. So, but, since 1960, it's at a perfect track record. But usually there's a lag. So, I mean, it can be, the lag can be 18 months. I think there's one case where it was a couple of years, but I think normally, 12 months, 15 months, you're on average, that's what we should look for. So I do think the probabilities, I should say, really favor a recession beginning sometime next year.
Yeah, maybe I'll just do that now. I had that as a question later on in the interview, but since we're on it, I'll share my screen here. And this is going back to 1980. This is from the Fed's website here, the 2 and the 10-year inversion. So we can see in 1980, it went below. This black line here is 0%. So it went down here. These gray bars are recessions, went below again. You got another recession, went below here. About a year and a half later, we get another recession. Same here, same here. This was the COVID one. It dipped below for a hot minute, and then we got a quick recession, but they printed their way out of that one. And if we zoom in here on the last few years, we could see since we last talked on the show, I was asking you about this, and I think we were at 0.46 or 0.47, so we're at about a difference of half of 1%, and we just hit below, and now it's still you get a better return for loaning the government money for 2 years than you do for 10. Is there? I was watching another expert. His name escapes me at the moment, but he said that it kind of has to hang down there for 60 or 90 days or so. Usually, if it just dips below and then drops and then comes right back up, that doesn't signal it. But we've been down below now for several days. What are your? Can you expand on this a little bit? What do you see happening?
I think I've heard that at some point in the past, but most people don't really talk about that. I think if you go back to the reason it could hang there for a tiny period is if the Fed, because in the last 3 cycles, not counting the 2019, or I can't recall, the last 3 or 4 times, basically the Fed stopped hiking when the curve inverted. They're going to go past that. It's going to be a little different this time because they have to hike to bring inflation down, because inflation is the #1 political issue. So they are going to hike a little bit more if they can. But I mean, I just think looking at everything, there's going to be a recession at some point. So arguing, because people point out, yeah, it inverted in 2019 or 2018, whenever it was, and then we had a bit of economy got stronger for a little while, but there was, even without COVID, we were headed for a recession probably in 2020. And another thing to note is historically, when you get these inversions, the stock market actually tends to perform well from the point of inversion to wherever it peaks, which is usually, in most cases, around 6 months before the recession actually begins. So I think those are the other takeaways. I'm not really keen on how long it's going to be inverted for, but I guess in some cycles, the Fed could, I mean, what they could do is they could, here and now, they could stop and say, we're going to start cutting aggressively. But I mean, they've only done one hike. So they're so far behind, because we're talking about the 2-year yield typically follows the Fed funds rate. And so the 2-year yield is way above it. So, I mean, the Fed should have started hiking last year. I mean, rear view window, 2020 hindsight, obviously. But that's how I look at it. To me, it's not that big of an issue whether it hangs down there or not. I mean, we're headed for a recession next year. I mean, if not, it might start at the end of this year. So I mean, thinking about it again, if the Fed, if they wanted to cut aggressively, that's one way the yield curve would steepen and it wouldn't be inverted anymore. But usually they cut when there is a recession and they know it's coming. So like the steepening is really when there's a recession or when there's a downturn. So I mean, that the steepening is, to me, is just as important as how long it's below that 0 point.
Yeah. I haven't checked it. Do you know how many more hikes the market has priced in, and what's your I thought I heard a number of 9 or 7 or something like that. Like, is that even possible?
Yeah, I mean, I looked at it yesterday, but it escapes me now. Yeah, I mean, I think something they could have like 5 more this year, or 5 or 6 more this year, and I saw maybe like 9 over the next 24 months, possibly. But we'll see. I mean, they'll probably do a 50-point hike at the next meeting, and maybe they can do another 50-point after that. But we'll see. I mean, it is, I guess. I mean, because the rate of inflation will probably come down a little bit at some point, but growth is already coming down. I mean, the last employment number was good, but employment is a lagging indicator. I mean, it's actually the most lagging indicator, so we can't really base anything off that. So I would, conservatively, I think the Fed will be able to get into 50-point hikes. So that would be 4 more in terms of the number. That's 4 more single hikes. So that's what I see. I don't think that they're gonna what the market is factoring in right now, or at least in the the bond market and the Fed funds futures. I don't think the Fed's going to be able to hike, do 8 or 9 hikes. It seems very unlikely. I mean, they will hike until something breaks. Maybe something breaks in the credit market. Maybe the economic data rolls over a little bit more. Maybe inflation doesn't come down. Obviously, the food prices as we get into next winter, and energy prices with the war that's going on. I mean, that's a huge issue. And, Russia, just if you listen to like leading geopolitical people who seem to know what they're talking about, like they don't want to stop at Ukraine, like they want to keep going. So, that like keep going into other countries. So, I mean, that's a huge wild card. But yeah, given, I mean, you have the inverted yield curve, you have a pandemic, you have, huge move in oil, there's going to be a recession. I mean, it's just a matter of when and the timing, and, will it be inflationary, stagflationary, or deflationary or disinflationary? Those are the real questions, at least for me.
Yeah. The hiking rates is kind of important because typically when they stop hiking, that's when that's really the catalyst in the rocket fuel for gold, correct?
Yeah, I mean, it depends on the economic cycle that you're in, because if you go back to the 70s, a couple of times it was different. It was actually when they started hiking, that's when that's when gold bottomed. It did really well, and then actually when they were cutting, gold didn't do as well. So it can work either way. But and that's a question I've been thinking about with this recent cycle. I mean, it's really interesting. But yes, in the last 20 years, it has been when they do the first cut, that's been when gold really takes off. And so I think, I think we will see something similar. I mean, assuming they can get in 2 more 50-point hikes. If we do have a recession next year, they will be cutting rates next year. But the market could the market could front run that a little bit. I mean, it could be when they stop and when they signal to the market, okay, we're done hiking rates, like gold will probably really explode higher at that point.
Yeah.
So I think gold will front run that a little bit.
Okay. Last time we had you on, it was pretty cool because we had just crossed an inflection point as far as the technical graph, and you mentioned that and I even used it as the hook to the beginning of the interview, was that when gold closes above 1900 on a weekly, monthly, and quarterly scale, that's you want to be into gold before that happens, if not immediately after, right? And we've done that now. We've closed above the weekly, monthly, and quarterly, and it even spiked all the way up to almost 2100. The number I wrote down was 2078, but it's around there somewhere. Are you still sticking to that narrative?
Yeah, I mean, the only thing I would tweak a little bit is, so the first quarterly close above 1900 came last week. And I think we closed at 2054 or something. So that was an all-time high. So if we're looking at gold's closes every quarter, that was a new all-time high. So that's very bullish in a quarterly sense. So a little bit of a longer-term time frame. Now, on the monthly chart, it closed February at I think it was 1900.70, and then so it closed the quarter at 1950. So that was a monthly close above 1900. But and these closes happen as if you look at the daily and weekly charts, it's correcting because it got up to 2078, as you said, and gold moved about, I think it was $300 in about 6 weeks. And so you get a really sharp move like this. Normally what happens is, in a really strong market, in a bull market, after that kind of a move, you get like a triangle or some kind of a sideways consolidation. So gold is correcting. It'll continue to correct for at least a couple more months. I think it's probably going to form some kind of this is just a guess.
Yeah.
I mean, I strongly think that it will continue to correct. So that's a high probability for me. Forming will it form a triangle? I think it will, but that's more of a 50-60%, probability in my opinion, but that's just my guess. I think it's going to form a triangle and break out from that, move much higher later in the year. But that's the only, the way it closed above 1900 and did those closes is interesting because it's still, it's correcting. It hasn't broken out on a weekly basis. I mean, the weekly all-time high is probably 2050 or 2060, something like that. So I would just amend it and say, we're actually lucky because I think this correction is giving people another chance. Like this correction that we're having, I mean, this could potentially be your last chance before we see at least quality stocks really move up significantly and quickly, to the point where it's like you're a month or two too late. Then it's like damn, this stock is 30 or 40% higher. It's so hard, it's so hard to buy it at that point. So I think I would amend that and say, now when gold is able to break above 2,100, that to me, that will be like, that's like your 1:45 a.m. last call when the bar closes at 2 a.m. So the weekly and monthly, that's like I don't know what the word is. So in a very big picture sense, we've already had like the last call if we're looking ahead on a, real bird's eye view basis. But if we're zooming in, then breaking above 2,100, that's like final. That's not, okay, this is the last call. I would say that's the final call. That's the real last call. It's when we break above 2,100.
Okay, yeah, because it's never done that before, so there is no resistance above that. It's a new.
And I'll mention there's two, because I like to look at history and do historical analogs. There's two comparisons to where we are, and so these comparisons are based on gold coming out of a steep decline, rallying up to the former high, and then consolidating. So that happened in 1978. It had this big downturn basically from like 195 down to 105, rallied up to 200, then it consolidated. So we're at that point, and we're at the same point in 2009, where in 2008 it hit 1,000. Then we have a global financial crisis. Gold corrected 30%, rallied back up to 1,000, then consolidated for 4 or 5 months. So we're at those points that we're at right now. We're very similar to those 2 points. And those 2 points, 1978, 2009, when gold made its next move higher, I think in 1978, it was about a 46% or 45% gain in, I want to say 5 months. In 2009, it was a 40% gain in 6 months. So we're set. That's just another data point that's making me super bullish on the next move higher. But we're in that correction consolidation point before we get that huge move. So that's another window into, where we are right now and what the potential is if, I'm right and gold is going to break out of this correction and consolidation and go above 2,100.
Okay. I want to share my screen again here and bring up the gold graph. If you guys are listening on the podcast, just click on the link below and it'll take you over to YouTube. You can see what Jordan and I are looking at. Okay, so this is gold here. You want to look at the daily or the weekly?
Either is fine. I guess we can look at the daily because it's kind of been. You have the weekly there. That's fine.
Here's the daily.
Yeah, it's kind of been.
Here's the channel that I drew. This line delineates when it hit the high back in August of 2020, and then boom, we hit it again. It's not a coincidence that it got right up to that same point, right? We're kind of in this channel here. I drew some of these resistance lines here that a lot of the technical guys seem to have. There's one around 1890, 1900 here. If we get maybe a triple bottom, the 200-day moving average is right around there, right around that downtrend yellow line. Actually, maybe I could just delete that. But I got a couple of resistance lines here in 1780, and then again down here at maybe 1680, 1675, something like that. What do you think the odds are in descending order that, do you think we'll ever see in the 1800s again here, or in the 17s, or even in the high 16s?
I would say it's close to zero for 17s and 16s, but it's possible we could go to, we might test 1880, but the real interesting thing to watch will be the weekly and monthly closes. Like I could see gold going to 1880, but then it won't close the month below 1900. So that's something to watch. The weekly and the monthly closes. But there is, 1880, that's one support level. There is an open gap, which is really, that was from the start of the invasion, or at least the lead up to it. I think it's around 1840-ish. So if you said, what's the, I always like to say realistic, because, worst case, best case scenario, I'd like to just say realistic. And so something that could realistically happen, I would say, near term, realistic worst case scenario for the correction would be filling that gap around 1840, 1850. So that's one level to keep in mind. But I would be really surprised if gold went below 1880.
Okay. Okay. One thing I noticed when it gapped up for the war and we touched the, or got, within a few bucks of touching the all-time high, things like Royal Gold and Newmont, Barrick Gold, Franco Nevada, they popped up and didn't really seem to correct down like gold did, Agnico Eagle. I actually put a bet in on the dust, DUST, which for the listeners is a 2x inverse of the GDX. So the major mining companies, once it popped up like that, I was like, okay, we've just hit the all-time high. I think it's extremely unlikely that we're going to blow past that without testing it a few times at least. So I took the dust for a few days. And I really didn't do, it wasn't as great of a hedge as I thought it would be, because in the past, I've seen the miners have corrected a lot more than the spot price of gold. And this time it didn't do that. Was there some big institutional investing? Maybe hedge funds are buying Barrick Gold or something? Why did they not seem to come back down with the gold price? Do you know?
My flippant response would be because the market knows that gold is going to move dramatically higher eventually. And so I gave you the 1978, 2009 example. In 2009, gold corrected, it rallied up to $1,000 in late February. It didn't break above 1,000 until I want to say the tail end of September. So during that period, gold corrected 15%. It was really a bullish consolidation. So during that period, GDX and GDXJ, they actually went up during that period. So the miners then were so strong that they were anticipating, they must have been anticipating, well, look at gold. Gold is going to, when gold breaks 1,000, it's going to go crazy. We got to get in. So I think what's been happening in recent weeks is very similar to that. Although I will say, if you look at today, you do have a nasty candle on a lot of these gold stocks, which have been holding up really, really well, outperforming gold, which is unusual. But I mean, I just think like in a very short-term sense, we could see a little bit of weakness in the stocks. And, perhaps, maybe that signals that gold has to test 1880. I don't know. It's a possibility. But if we do get a little bit more weakness in the stocks over the next couple of weeks, that's going to be a really good buying opportunity. And so I wouldn't expect it to last for too long.
Okay. And I've been getting so many questions since our last episode on physical purchasing. And, a couple months ago, I guess I didn't think that 1830 was a good price. And now that it's more expensive, they want it. I think that listeners need to understand when you go down and you order these metals from Andy Schectman, or you go down to your local coin shop, oftentimes the spread or the VIG or the rake, if we were playing poker, the spot price will be 1,900, but you got to pay 2,050 to get your gold coin, right? In these moments, even when we have a run up like that and then it comes back down to 1,900, your spread now may be $200 instead of 150, even though that it's come down. I had some extra currency in my pocket today, so I went down to my local coin shop, and he had all the display cases covered with his velvet black thing. I said, "Steve, what's up? What do you got?" And he said, "I don't have anything." I said, "You don't have anything?" And he said, "No, I don't have anything." And I'm like, "Well, do you have any gold coins?" Because I always go in there for silver. And he said, "I just sold my last 6 today." I said, "Well, when are you going to get some more?" He says, "I don't know." So maybe we're starting to see a little bit of this come off the market. And I think that may be one of the first indicators there. Am I off? Or?
I think you're off, and I'll tell you why. Now, the physical market is not, I'll just say I'm not an expert in that market. I mean, there's other people who know far more than I do, but if we look at what moves the price, it's big buying. It's, so these people on Twitter and, those platforms, they complain, why do I have to pay so much for silver? Well, think about if you go into the store to buy anything, if you're buying a, huge amount of something, you're probably going to be able to get it at a discount versus like if you're just buying one or two. So people who are going into coin shops and buying a few ounces, even 100 ounces here and there, it has no impact on the price. I mean, you can look at the points when silver has had huge moves down, like 2008, for example. Like I remember that, and people were talking about, oh, I can't find anything. I can't, everything's sold out, but the metals are crashing. And that's because the market is really, it's big money. Like it's pension funds, it's, sovereign funds, hedge funds, university endowments, that, people who buy significant amounts. And yes, it goes through the futures market or GLD or, whatever instruments they use. That big money and big buying is really what moves the market. And so a lot of the, it's, it's good fodder. It sounds good on social media. I can't even buy 1 ounce of silver, but it really has zero impact on the market. Like it really, yeah, but I'm not an expert on all aspects of the physical market, but physical demand it's always like strong. All these bullion guys, you'll never hear them say physical demand is weak. Like it's always strong.
Okay. Me so going down and getting a monster box has nothing to do with the market.
That's my 2 cents on the physical market. It might only be worth 2 cents, but that's just my sense. Not to overuse the word, but my sense is it doesn't really matter. It doesn't move the market, unfortunately. So, and there's a lot of people who disagree with me and have very, very strong opinions on that. But I'll just leave it at that. That's my view. But you can listen to the other side. But in my opinion, I've been following the market for almost 20 years, and it doesn't move the market.
Okay. All right. Let's see. I got to say with your, I'll give a shout out to your premium subscription. That is a lot of fun. I love getting the weekly reports and, buying or accumulating on demand. And I got to say too, that your flash updates, like we came out with one this morning on one of the junior gold miners that you recommended we bought a little while back, and you got some news on it that let us know we should part ways, which I did this morning. At just a little loss instead of hanging on to this thing for a year or so, and just watching our shares get halved. So it's a lot of fun. I really enjoy it. It's very cool. You also got a YouTube channel, and your website is thedailygold.com, so people can check you out there. You got any parting words, Jordan? Final thoughts?
Well, I'm not a man of brevity, but I'll just say, yeah. I think we're in a really good setup in that we're probably going to continue to correct here for, I would say, at least 2 or 3 more months. But I really like the setup of the market, and that gold is in position to. Let me just be conservative and say I think before the end of the year, or before next winter, or maybe I should say before the end of autumn, because we do see lots of gold breakouts in September. So maybe maybe it's setting up for a huge breakout in September. But the market, we can't predict the future, but the technical construct for gold, it's just super bullish, and this market can really take off if it breaks above 2,100. And eventually, that's going to drag silver higher, which is underperforming now. And I think the stocks are going to do really well. So I'm really optimistic about the setup. And this obviously, if people are complete newbies, you can spend the next couple of months just reading and learning everything you can about the market before you get involved, because there's huge opportunity, but if you don't know what you're doing, you won't be able to capitalize on it, and you can come out of it losing your shirt, unfortunately. So you have to get educated, and you have to have a plan. And when we own these companies, not all of them are going to work out. So when you see some negative signs and the risk reward isn't there, you sell it and move on to something else. Because if you don't, you don't want to risk holding, most of these stocks, these companies, they're going to be acquired, or, they might fail at some point. I mean, these are not 5 and 10 year holds. Yes, you can hold them for like 2 or 3 years, but you can't hold these things for 5 or 10 years. They are going to go down 50, 60, 70% at some point in the next 5 years. But on the way to that point, I see a lot of these things having 5x, 7x, 10x potential upside. So you have to, knowing all this, you have to get educated and have a real plan for yourself and follow that plan. Because if you don't have a plan, you're going to be too emotional. You'll buy at the wrong times. You won't sell soon enough, or you sell something way too early. You have to get educated and formulate a plan of how to invest, and then manage your investments as we go through this cycle.
Well, sir, that's why we pay $149 every 6 months to to sign in with you and get to follow you while we do it.
Thank you for your business.
Yes, sir. I will be with you for quite a while. Thank you again for coming on, Jordan. Please like and subscribe this video. Put your comments in the section below, and Jordan and I will respond to them. Follow him at thedailygold.com. Thank you guys for tuning in, and we will talk to you next.